So let's get started talking about building your trading plan. Now, I'm going to start out by kind of making an apology or an explanation. This class tonight is a lot of words, and you'll think that I'm lecturing to you. It's almost like a teacher or a parent trying to tell a kid what to do. Okay? Don't take it that way. I'm trying to share with you not just my insights, but the insights of all successful or professional traders. And this is imparting some general knowledge that isn't just a piece of information. And it's almost like giving you homework to do. And building a trading plan is not something people like to do. It seems to be most online traders just want to get online and trade. And so I don't want you to feel that I'm lecturing you tonight, but this is critically important. Now, also, if you notice on your screen, I've set some handouts for you. One's called Combined Trading Plan Handout. It's going to give you a general guideline on how to start your plan. It's a blank form, and it's a little bit of information about what you'd want to incorporate in your plan. I've also given you a day trading guide and a 4-point trading plan. But the fact is, everybody's trading plan is individual. So in order to become a successful trader, you need to develop a written trading plan where you put all your necessary trading rules. Now, a trading plan is not your strategy. Your strategy is incorporated in your trading plan, and it's also one of the best places to start building your trading plan from. Now, there is no such thing as the ultimate trading plan because there are no two exactly the same traders. And for this reason, there are no specific rules. There's some general guidelines, but there's no rule what you have to incorporate in your trading plan. There's no rule how you have to trade, what you have to do, how extensive you have to have this plan. But you'll find that the better your plan is, and the more you develop it over time, the more successful you're going to be at trading. So it's always better to develop one's own personalized trading plan and modify it as your experience grows. So think of it as a checklist. If you just think of this trading plan as a way to think of not making any mistakes when you're going to make a trade, not missing something you should be doing. Like, I don't know how many times I've heard from people that they've got this beautiful, perfect trade on the euro dollar, and they're going to make, and they should have made tons of money. But the fact is, they forgot to look at the economics calendar. And even though the ECB wasn't meeting today, Mario Draghi was making a speech somewhere. Now, 2 hours later, after a speech, your trade was perfect. You would have made all the money you could have possibly wanted to make. But the fact is, because you didn't realize that you needed to check the economics calendar and see what was on the events for the day, and you didn't, you forgot about it because, when the ECB is having an interest rate decision, it's in the headlines everywhere. But when Mario Draghi is making a speech somewhere, nobody, it's really not in all the news somewhere. And all he did was cause a little bit of volatility in the markets. But the fact is, you got stopped out on a very good trade because you weren't prepared for that extra volatility. Or maybe you should have just waited till after the speech was over to enter your trade, because you did exactly what you thought it was going to do. But while he was speaking, it was going up and down because traders are trying to interpret what he's saying. So think of your trading plan should be thought of as just a template for your trades in the market. It should include all of your steps. Like if I were to say to you, or when I was teaching, when I was teaching my kid to drive, okay, sure, we had to study the manual and get so we could pass all the tests. But then when we actually went out in the car and I was teaching her how to drive, first step, what do? Put the keys in the ignition. Put your seatbelt on. Uh-oh, I got it backwards. Put your seatbelt on, then put the keys in the ignition. Then check your rear view mirror, check your front mirror. Check your side mirror. And then if you're parked on the side of the street, put your blinker on, or maybe we should turn on the engine first. We forgot to turn on the engine. You know why? Because we didn't have it in our list correctly. Well, that's exactly what this plan is the same way that you would teach your kid or you were taught the steps to follow, in a car. And after a while, it just gets to be automatic. But if you don't do these things and you forget or you neglect sometimes, what do we have? We have accidents. Okay. Well, in trading, an accident can be much more costly than it is just, getting a nick on the curb. But in order to build your own trading plan, you should put in several things. What the strategies will be you be looking to trade. And like I said, starting your trading plan, the easiest way to start is with your strategy. You already kind of developed something in your head. You have some way that you're making a trade. Well, put it on paper. Not the particular trade. Put your step-by-step process of what strategy you're going to use. I'm going to use MACD, and when MACD crosses over its signal line, and I've just broken through a support and resistance level, and I'm in an uptrend, I will exercise a trade. Okay. Well, you know what? When you write it all down, you might find out that it doesn't make a lot of sense, or you missed a couple steps in there. So you need to write it down, and you'll determine it all. Okay. Well, then how are you going to figure out your exact entry point? How are you going to figure out your stop loss level? Then how are you going to incorporate your risk management? Because all of these are just filters, because we want to be able to filter down into only high probability trades. And by using this trading plan and your filter system, guess what? You're going to throw out most of the garbage because it's not going to make it through all of your filters and all of your steps and your process. Now, when I started trading 45 years ago, I traded, a lot of you know, I traded in commodities, and I only traded agriculturals. And basically, for many years, I traded two things: orange juice and coffee. That was it. Because none of us become masters of many, many assets in many different sectors. And unfortunately, with CFD trading and online trading, we've got the doors open for thousands of different assets right in front of us on our screen. And too many traders will trade Apple and an hour later be trading General Electric, and the next day be trading Walmart, and the next day they'll be trading the euro, and an hour later they'll be trading gold, and then they'll be trading oil, and then they'll be trading pork bellies, and then they'll be trading Bitcoin. You can't be an expert at all these. You can't find the time of the day to do the proper research in all these. So one of the best things to incorporate in your trading plan that'll keep you from going off into the far tangent when all the headlines are reading something about Apple and you want to trade Apple, your trading plan, you've already written it up. What is your trading plan? It says the assets you are willing to trade. Of course, you can always change it. But maybe if you sat down and said, you know what? I'm only going to trade the euro and the crosses. No, euro, pound, euro, dollar, euro, yen, euro, Swissy. That's enough to keep you pretty busy. Okay. Now, if you like high-tech stocks, maybe you'll say you trade those in Forex, and I'll trade Apple and Intel. But you can't be all over the place. And you find by defining this in your trading plan and sticking to it that you'll be a lot more successful, because you can't build your charts. Keep your charts, keep your technical indicators. I mean, I have friends and I have students that they use every type of scanner in the world because they're looking for trades all over the place. They're scanning for this, they're scanning for when RSI is over 70 and MACD does that, and they've got to set up a scanner. And guess what? They're getting thousands of trades a day. Well, you can't even go through it all. If I'm only trading 6 assets, I don't need a scanner. I can look and see what they're doing. And then the next thing is, what will your daily routine be? Now, daily routine is fine for people like me that trade in the markets every day. You guys have regular jobs. Well, you may only trade on Mondays and Thursdays. You may be free on Wednesday evenings when the wife takes the kids off to somewhere else. You may be a single guy and you have your evenings free, but not Friday. It fits your schedule. Figure out what your routine is going to be. because you've got to dedicate so many days and so many hours out of your routine to analysis, research, and information. Maybe you'll say you're only going to make trades on Thursday only. The rest of the week, you're going to do just research charts and watch the market. That's perfectly fine. I only make trades 3 hours a day, 3 days a week. That's it. Because my other days and my other times are dedicated to research and preparation. And also, you learn the market's personality. Markets have very, very specific personalities. And different assets move at different times of day. Like if you're trading euro and its crosses, you're going to have most of your activity when? When the Eurozone markets are opening up and economic data is flowing. Okay. If you're trading stocks during earnings season, you're going to have it before the market and after the market when announcements are made, press release. Okay. So different times of day have different attitudes. Well, this can be written up in your plan. So I know we're talking about a lot of stuff. So where do you begin? So like I said before, start your trading plan with your strategies. So if you're trading price action setups or off key structure levels or structure trading or advanced patterns, then you should put them down first. Okay? Gives you a starting point. You got your paper and pencil. But you can be doing this in an Excel spreadsheet. You can be doing it in a Word document. You can do it any which way you feel comfortable. I did mine for years on index cards, and I had index files everywhere. And to be honest with you, for many, many years, I had a checklist of things that I had to do that I, photocopied, and I would actually fill them in. Now I kind of do it in an Excel spreadsheet, not my whole trading plan, but I have all the steps. So it's just blanks, and I fill it in and drop it in as I go across and fill everything in. And did you check the economics calendar? Did you check this? Did you do this? And I'm just checking my little boxes. Okay. And what price am I willing to enter? What time? All of that just comes in my little boxes at the end. When I filtered through my trading guide already, then I just need to go to my platform and actually execute it. And what am I executing? Directly off of my spreadsheet, because I'm executing a limit order at a specific price, setting my stop loss because I already figured out what my stop loss has to be. And there I go. Now, having written strategies with your risk tolerance and money management is like having a market blueprint. This blueprint is essential to developing the discipline that will lead you to the road to success. Okay. Now, I mentioned the next thing is it would say what instruments you're trading. For example, you may be focusing only on the euro US dollar, perhaps the euro US dollar, pound US dollar. And make sure you stake this in your plan. Word that I call, sorry about that. Come on. I use a word that I call stick-to-itness. It's not really a word, I made it up. But the creation of a trading plan is highly useful, and it reduces the possibility of bad or irrational decisions. And if you stick to it, you're going to find in the long term, you'll be more successful. And you start building a trading journal because you start building all the history of all of your trades. Because one of the most important things in trading is historic data. Being able to go back and see, when I saw this pattern develop in the euro before, this is what I traded, this is how I traded it, but this was a bad trade because this, and this. So maybe you can learn from your past, or you have history in the markets. And it sounds ridiculous, but it isn't. Because all you're trying to do is have knowledge and discipline. So you need to stick to it. Now, this is where I'm going to start lecturing you. Because if I asked 100 traders out there to send me a copy of their trading plan, or just what they wrote up for the last trade they made, I'll never get it. Never gotten one ever. So unlike business owners who generally have a business plan in order to provide a strategic vision to employees and to stay focused on their primary line of business, most traders never take the time to create a business plan. Now, in essence, you are a business. Trading online or trading CFDs, however you want to call it, is a business. It may be a part-time business. It may be a small-time business. Maybe it's an online business, okay, but it's a business. Now, if you wanted to open up a shop in the mall, yeah, you might say, I got $20,000 extra in my bank account. I can do this, but that's not going to give you any information. You don't even know how much deposits you'll need to rent the store, how much cash you need to figure it out somewhere. So maybe you went to your parents and your brother-in-law. Maybe you went to some of your college friends and said to them, you know what, I'm thinking about opening up a retail store in the mall, and I'm going to need a couple investors. They'll say, okay, how much you need? You say, I don't know. Well, they say, yeah, I'll be glad to invest in you. You're my friend. I trust you. Come back to us with some type of a plan. So you write it out on a one-page. You do some quick research. You go back to them. They say, fine. Your brother-in-law says, I'll give you $10,000. Your folks said, I can give you $25,000. Your other friends say, I can give you $50,000. Okay, but they're not just giving you a check. They want you to write something up now, and they want a contract. They want to know where their money's going. They want some type of share, stock, investment, ownership. Okay. You go to the lawyer. Lawyer says, fine. What am I writing up? They're giving you $50,000. What are you giving back to them? How many shares? Let me see your business plan. Let me see your business model. How many shares are we going to issue? Or how much percentage of the business you're going to give them? Then you go to the mall and say, I'd like to rent your shop. Guy in the mall. Now, we're not talking about a strip mall. We're talking about a big mall. Well, he has to decide whether he wants you as a tenant, whether your business will fit his mall. Will he get enough footfalls? Can you afford, or will you be able to afford to stay in that mall? He doesn't want an empty store. Doesn't want a going out of business store. But can you stay open the hours he wants you to be open? Or you can be able to afford to hire staff to be open. What insurance is he going to require you? Can you afford that insurance? Can you pay the monthly advertising fee for the mall? Okay. It's more than just a lease. But all of this, he wants to see your business plan. Then you find out, well, you raised $50,000, $75,000 from your friends, but you found out you need, $150,000 in inventory just to open the store. Another $50,000 of fixtures. The sign out front's going to cost you $10,000. The lawyer's already cost you $10,000. Well, you realize you need $100,000 more than what you raised from your investors. So you go to the bank. Bank wants a business plan. Well, if this is your business, you need a business plan. Or what do you need? A trading plan. Okay. Now, in most lines of business, not only do we need a plan, we need to be able to call it to action. We need to be able to hire people. We need to get into the inventory in the store. Once we get the inventory in the store, we got to know that what size blouses we need, what size range, how many do we need to stock, how much inventory can I fit in my back office, in my back rooms, okay? Then after you've got in, are you going to add analysis? How are you going to do your analysis? Maybe I sell more smalls than I sell larges. Maybe I sell more pinks than I sell yellows. If you're not doing this kind of analysis and writing it down and putting it on spreadsheets and understanding what your inventory is doing, you're going to be closed and gone in no time. So you have to figure out also what your key evaluation matrices are and how you're going to evaluate your performance. Now, for me, I have a very firm rule. I evaluate all of my trades after every 10th trade. Very down. Now, 10 works for me because it fits my trading style, because on the average, it'll take me 3 months to place 10 swing trades or about 4 days to place 10-day trades. So that means once a week, I'm sitting down and I'm spending a day analyzing each one of my trades, making sure they're finished and written up correctly. Because you know what? A good trade isn't necessarily a trade you made money on. And a bad trade isn't necessarily a trade you lost money on. If you made a trade and it went against you, but you got out of the market with a very small loss, that's still a good trade because you stayed within your risk tolerance. Because we know you're not going to have 10 winning trades out of every 10 trades. We're hoping you have 5 winning trades out of every 10 trades, and the losing trades, you've limited your risk, and on the winning trades, you've maximized your profit. So after every 10 trades, you've made $100 in each of your winning trades and lost only $10 or $25 on your losing trade. So you still had a net profit. But you need to evaluate this, because you might find out you do better trading the euro pound than you do trading the euro Japanese yen. And even though you don't notice it because you're not seeing in depth, maybe you should only trade the euro dollar or the euro pound because you're more successful at that. So, but you figure out what your golden rule number is. I know guys that are executing 10 and 12 trades a day. I know other ones that are doing high frequency trading, executing hundreds of trades a day. But you figure out what your evaluation requirement is, and you stop everything. Once I've hit my 10th trade, I stop everything. I'm not doing any more trading. I'm doing only analysis. Now, how do I analyze my trades? Well, I follow the keep it simple, stupid rule, the KISS rule. You don't need to make it all complicated and involved. You need to take a look at the last 10 trades, how you did on them, which ones did well, which ones didn't do well, which ones made money, which ones didn't make money, what type of strategy you use. Did I trade this one after a double bounce off of a support line or after a double breakthrough and then a rejection? Did I use a pin bar and a candlestick pattern? Which worked best for me? Okay. So these are just some of the things to keep in mind. Then we already discussed it briefly, what time of day you're going to trade. Isolate yourself. It's your rules. Okay? It's nobody else's rules. You figure it out, but it's important to incorporate that. Okay? And then lastly, define your trading edge. Your trading edge is basically your strategy. Okay? But this gets put all together. Like, I'm only going to trade this, this, and this, or I'm only going to trade when this happens, but the last piece is going to be I want to check my volume. Okay, if volume supports my decision, then I'm going to make this trade because this gives you your edge. So similar to the times of day you trade, keep your trading edge down to 1 to 2 setups when starting out. Don't make your trading strategy overly complicated. Okay, and you'll find when you're writing it all down, you're going to get tired of writing down. Okay, I'm going to do this, and do that. It's easy today with computerized charts to drop 92 things on your charts and look at them. But if you write it all down, you realize a lot of things and you'll be able to get past them. We've talked about identifying your assets. Now, here we go back to my little lecture again. This past weekend, we watched Tom Brady win the Super Bowl for the 6th time. He's making multi-million dollars a year over and over and over again. He's married to one of the most beautiful actresses or models in the world. I think between him and his wife, they have $500 million in net worth. But I guarantee you, This is Super Bowl. Super Bowl Sunday passed. Monday we had Sunday and Monday we had parades. Tuesday we had the big celebration. But I bet you by this morning, they were all in those locker rooms evaluating every play that they made, looking for ways to play better, looking for mistakes they made, looking for all the shortfalls. I guarantee you the 2 weeks before Super Bowl, they were sitting down together and analyzing every one of their opponent's plays, looking at the strengths and weaknesses, looking at how they're going to react, learning every new play, and then going out on the field and practice. Well, if a man who's making $100 million a year has to do this, why don't you? This is a man that's been professional, been doing this, for 20 years. You're a new trader. Why don't you have to do this? Okay, so if athletes do this, businessmen do it, sport, don't you think Tiger Woods goes through all this? Don't you think he knows the roll and the lay on every green, on every tee? He knows exactly where to go, but he's also been checking the weather, the wind, everything. And practice. Everything's written down. He's got a communication between him and his caddy. He knows exactly what to use, what shot to make, how to stand. No, better than we do. But I mean, all of this comes from practice. Now, this is why it's important. Because once you have goals, you have objectives and how you want to reach those goals. Because a goal without a plan is just basically a wish. If you're not going to put the effort into it, you're not going to be successful. So, again, the most important part in the way to start your plan is with your trading strategy. Start that in the middle. You don't have to use things overly complicated. You can use simple trend lines of support and resistance. You can use moving average crossovers. I start every day, every single trading day, by going through the assets that I trade and putting on the new levels of support and resistance and looking at what my chart is trying to tell me. I haven't looked at the market yet. I'm not even thinking about trade, but this is my habits. I check my trend lines. I put my support and resistance lines on there. I look at my charts. I look at the economics count, and I actually go back and put little marks on my calendar, on my charts, to let me know when there's events. Now, today, a lot of the computerized charts, you can just click on it and it'll drop the events on your charts for you. But I make all kinds of notes on my charts because I want to figure out market momentum. I want to see what the market should do, what I think it will do. Whether I'm trading or not. If I think, okay, Trump's going to say this, and this is what I expect after his State of the Union the other night, and this is what I expected this morning in the stock market, and with the dollar and gold in response to this. Okay, I just want to see if I'm right. I didn't trade it. I don't even trade those out. But I want to see if I was right. I want to see what the market was doing today, the overall tone of the market. Were we in risk aversion? Were we risk positive? Okay. Are people running to the dollar and getting out of the stock market? Are they running over to Thai tech? Because all this affects the assets I trade, and I only trade currencies now. But all this affects those assets that I trade. Now, here we come to the tough parts. Is your stop loss, your entry, and your exit point. Okay. I can't tell you where to put a stop loss. I can tell you where you could calculate where you possibly should put your stop loss based on the volatility of the market, where the last candle was, where the swing high or the swing lows, or you can use support and resistance lines. There's many ways to determine where you'd have to put your stop loss. But the final part of your stop loss is figuring out where you have to put it, then how much exposure you have, because that's going to help you decide, you know what, I can't make this trade because I've got to put my stop loss where I have a potential of losing $600, and I can't afford to take the loss of $600 with the stop loss. So therefore, I'm not going to make this trade. Or my stop loss has to be here with the potential of losing $600, but I don't see enough upside reward because I can't possibly make $1,800 out of this trade. So therefore, I'm not going to execute that trade. Guess what? You just filtered out a piece of garbage trade. The other thing is how much you should have in the market at any given time. That's an important part. Because even though I said, analyze after every 10 trades, well, you know what? You could have 10 trades going on in the market today or only 2 active trades. Just be careful of how much capital you, anytime, and this should be in your trading plan, how many active trades you can have and how much capital you can have at risk at any time. Your trading plan should include not only how you'll calculate your exit points, but how you will exit. Because yes, you exit through a take profit point and a stop loss point, but maybe you should have in there, okay, if I see volume moving against my trade and I see it not, go through the support line like we expected, okay, I'm going to exit the trade. Or I see this happening where the trend is losing some of his legs or some of its momentum, so I'm going to exit my trade at this point. Have a clear-cut strategy. Are you going to use trailing stop losses? Okay. Do you even know what they are? So all of this should be written up in your plan. And ultimately is how much money can I use per trade? That's very, very important. And now 9 and 10. Remember we talked about coming up with your own number of how many trades and then stopping and doing your analysis. Well, that's important. People can see the importance of that. But I also have a rule. After 100 trades, regardless whether they're successful or not successful, I don't care. After I have completed my 100th trade, the next day I don't trade. I don't look at the computers. I go out and play golf. Take the day off. Go meet some buddies for lunch. Go spend some time with my daughter, my granddaughter. Okay. Why? And this is not on a federal holiday. This is not on your vacation holiday. This isn't your Saturday, Sunday. This is, if you trade every Tuesday and Thursday because the wife has the kids at soccer, well, after you've had 100 trades, you know what? You say, honey, let's go out to dinner tonight. I'm not trading this Thursday night. Okay? Because it gives you back control over the markets. You know how you always try, if you're a drinker, you want to, at some point, you want to check yourself and say, I'm not addicted. Okay. Don't want to let myself get addicted. So you exercise control. Or, you see your pants are getting a little bit too tight after the holidays and you say, right after New Year's, I need to get back down. I need to drop 8 pounds. Okay. Because you're taking back control. Same thing with this. Take control of the markets. You'll find when you have this self-imposed break, you go back to your discipline. And the last thing, which a lot of people think I'm totally crazy at, is limit up and limit downs. When to just close your computer and walk away. Now, some days, go in the market, you set up a trade and you get it off. And before you know it, you've entered the trade and the market blips in your favor. You take your profit. You've had a good 15-minute run, a 1-hour run. You didn't expect it to go that fast. But for some reason, you trade the euro, US dollar at 114 and you bought it long. And for something happened, we don't even know what happened. But it went the way you said, but it went went up to 115.12, 115.18. You made a lot of money. You closed out your position. Because, hey, something went, not something went crazy, not something went, something drove the asset up faster than you expected to. It gave it some momentum. You took your profit. You're sitting there. You've made your $200. Well, you know what? Close out the rest of your trades. Close your computer. Take your profit and go away smiling. On the other hand, if that trade, before, as soon as you open it up, you didn't have it open for a second before you got stopped out. Now you're getting pissed. Did a second trade, same thing. You know what? Close your computer and go fishing. Because what happens is once something happens, whether it's good or bad, if your first trade does extremely well, what I just talked about, met your goals, did extremely well, you tend to get cocky. On the other hand, if you have a couple really bad trades, you tend to get mad and start pushing and trading, trying to push that market and trying to recover what you just lost. The best thing is to either way, close your computer. Whether you're trading Tuesday and Thursday night, just close it out on Thursday, come back on Tuesday, come back with a fresh attitude. Come back, ready to start trading. Get past, because we're human beings, we react. So it's important that we know how to react and know when things are too good. When you've had a really good day at work and you come home, and hey, fine. You're in a really good mood, you tend to take higher risks. In a really bad mood, you tend to make mistakes. So now I've included tonight with your handouts, like I told you earlier, 3 handouts. Please click on the download button now. Okay, download them to whatever device you've got them. You're attending the webinar, because you cannot get these except during the live class. So you can't download them during the recorded class, and there's nowhere else to get them from. Okay. Now, one of them, I've incorporated this on your screen, this absolutely hard trading plan. But for a long time, it was the only one I could actually find on the internet that had a form of some sort. Finally, I put one together for you, but I've given you both. But this one's just kind of very minimum. This doesn't even have enough writing. The fact is, you can start your trading plan with wherever you want to start from. And like I said, start with the things you're doing now. Just look back at the last trade you made. How did you make your decision? Write that down. Not I opened the trade at 130. Write down, okay, I used this oscillator, this indicator, this, and I made this trade. I calculated my stop loss and my take profit by using this. I have this much in my account, so I can risk that. Start out small and keep expanding it. And ultimately, the most important part is keeping a journal of every single trade. Okay, your open, your close, your stop loss, your take profit, how much profit you made, how long you had the trade going on. Now today you can download it from your portfolio on your trading platform, but you need to have your notes and because when you go back after 10 trades, you do your analysis. If you got to run and gather everything together, then it becomes a real long mess. But if you've been writing this down and have it in your journal, when you have to do your analysis and then write in all of your analysis after each trade, you'll find it's a very helpful learning process. And eventually you want to become a better trader. And if you start learning or start getting in the habit of realizing the actual trade itself is the anticlimax of all the work you did to get there, and get the enjoyment out of being successful and building your steps. So, if you go in Las Vegas and you throw a chip on, double zero as you walk past the roulette wheel, and the guy screams double zero and he pays you 35 to 1 and hands you put down $100, got 35, you're really happy. But it's really anticlimactic. You got no self-reward out of it. And it's not going to happen the next time you walk through. But if you get into the habit of, or get yourself into building your business plan and being proud of it, building your decision-making capability, being proud of it, understanding what you're doing and being proud of, when you make that actual trade and it's successful, you have something really to be proud of, because you built all of this to get there. So the whole idea is the more effort you put in, the more reward, not financial reward, but the more self-satisfaction you get. When you get down to the point of reward and self-satisfaction, your portfolio will automatically start to grow. And you'll find that you can be a long-term trader that's a long-term successful. Okay. We're not going to get rich. Believe me, I've been trading for 45 years and I've supported myself with this, but it didn't make me rich because I didn't have $1 million to start out trading with. When I started out, we didn't have such things as leverage and margin. But ultimately, what do you want to do? You just want to see that portfolio continue to increase. So if you're starting out with $100,000, maybe you can get rich with it. But as long as you're making money, eventually that portfolio will keep growing and growing and growing. So start your trading plan somewhere, and you'll find that it'll keep growing as long as you're mentally at that stage and you started somewhere, you'll keep adding to it. And you're not going to start out right away in an orderly fashion. You're not going to start out necessarily in an easy fashion, but you can keep modifying it. I don't know how you'd set up your Excel sheets. I don't know how you do it in Word. There's all kinds of formats out there because it's no different than actually setting up some type of a business plan, okay, some type of a scorekeeping system, some type of a tracking system. You use what you're comfortable with. And on that note, I'm going to say goodnight to everybody. But if you have any questions, go to www.alvexo.com and go to their education center. They have all kinds of information to help you out. They have strategies laid out for you. You can go there and start some basic beginning Forex strategy and use those as your center of your chart and modify them. So pick their text up, drop it in on how to trade a moving average crossover or how to trade this, and drop it in and start modifying that to make it your own. So thank you very much for joining us. Thank you for supporting investing.com and Alvexo, and we'll see you again real soon. Best wishes out there. Good night now.